Corporate finance practice problem using OneNote. Payback period. Get ready, it's time to take your chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're going to be in the icon left-hand side in the practice problems down in the 1216 Payback Period tab. Also note, when using OneNote, take a look at the immersive reader tool. Many of our presentations will be mirrored down in this area, the text area, same name, same number, transcripts that can be translated into multiple different languages and either listened to or read in them. Closing out our tab up top, we're going to have our information up top. We'll do our calculation down below. We're going to be calculating the payback period, which sounds really dramatic. It's payback time here, but really that just means when we're going to get paid back our money if we have a long-term project. So the general scenario here being that we have some type of long-term project. We're going to put down an initial investment on that long-term project. We expect a return on that investment to be happening over years into the future. We're typically going to be thinking about a project that's going to have returns years into the future. And the question then is going to be, when am I going to get paid back the money for the original investment? It would make me feel a lot better once I have my original investment back. After that point, then everything beyond that is in essence profit. Now note that when we talk about the payback period, there's going to be major restrictions to the use of the payback period because it does not take into account the time value of money. So it does have an application. It's a good calculation to use. But when we look at these projections into the future, we're taking multiple different kind of scenarios. We're trying to take as many snapshots as we can, look at the future in multiple different ways so that we can then make the best estimate that we can. When you're looking at book problems, they're often going to emphasize the weakness of calculations that do not take into consideration the time value of money. So we want to emphasize what the restrictions will be of the payback period, not to say that it's not useful, but to see where the limitations of it are. So obviously when we're looking at the payback period, we're thinking about when we're going to get our money back, and that doesn't take into consideration the time value of money. It also does not consider basically our income after that point in time, because it cuts off at the point in time we get the money back, and after that point in time, that's when the revenue is going to be taking place. So it's nice to know that, but if I'm comparing one project to another, then I probably want to have more detail on that as well, so I can pick the one that with more information to get more information about the time value of money and what's going to be my total return on the investment. Okay, so we're going to say the investment is $220,000. You can think of this investment as anything we're putting a substantial amount of money down up front to get a return in the future. That might be buying equipment, might be investing in a project. It might be us just putting money into an investment or something like that. Anything that we're going to put a substantial money down now and get a return in the future. Cash flows, we're going to say for product A and product B, it could be inventory as well. It's going to be assumed to be years 1, 2, 3, and 4. We're going to compare these two flows. We have product A, 70,000, 40,000, 60,000, 70,000. Product B, 90,000, 55, 50, and 40. Now, if we just calculate what our net profit will be, we're going to say, all right, well, if I just calculate this out, we got the 70,000 plus the 40,000 plus the 60,000 plus the 70,000 minus the 220 that we're putting in. That's going to give us a 20,000 net gain for the product 1 that we would be putting an investment in. If I'm looking at product 2, we'd have the 90,000 plus the 55,000 plus the 50,000 plus the 40,000. That's what we would receive over 4 periods. We're estimating minus the 220,000. We're going to get the 15,000. Now note here, that means that product A looks better, although we're not taking into consideration the time value of money, which could be important given the fact that this first one pays us more in the first year than the second one where we might get paid at a later point in time. We're not going to look at that right now though. We're going to look at when we're going to get our 220 back, because that's probably our first initial concern, right? And that can give us an idea of how much risk is going to be involved in that. Notice when I ask how much time it takes to get my money back, I'm not even really considering the net profits with that question. I'm just saying, when am I going to break even? How long does it take before I break even, not even considering time value of money? So that's going to be our question with the payback period. All right, so let's do that. We're going to go down here, and to do this calculation, we typically do kind of a running balance calculation. So you'd set up your table like this, whether it be in by hand or whether it be in Excel. I do recommend practicing this in Excel. We do have an Excel worksheet on it. And so we could say that 220, and then we're just going to have our series of payments. This is the amount of money that we put down, right, the 220, and then we want to see when we're going to get that money back. How long does it take? Well, let's just list it out. If we have period 1, we're going to receive, we said $70,000 for product A, the first option, the first investment that we could have. So that means, all right, well, then that means 220,000 minus the 70,000. That means we still have 150,000 after that point that we haven't recovered. Are we going to get it in year 2? Well, let's check it out. In year 2, we're going to get 40,000 for product A. And so we had 150,000 that wasn't recovered yet, minus 40,000. So that leaves us with 110,000 we still haven't got back yet. Are we going to get it back in year 3? No, because year 3 we only get 60,000. We still have 110. But I want my money back faster than this. Minus the 60,000. That means we still have 50,000 left. Are we finally going to get it back in year 4? We're going to get our money back in year 4. And we're going to say minus the 70,000 we get in year 4. And that means, yes, we got it back at some point after the 3rd year. So at some point in year 4, we got the money back. So that's good. That gives us one kind of round number. We can say, yeah, so at some point in year 4, we got the money back. Now, note this calculation also gives you our net income calculation that we did here, which is nice. This running balance is a nice pictorial way to see the cash flows, although it doesn't take in the time value of money, and it does get you to basically the net income, after that full time period. So that's nice. But the payback period itself we don't really consider this last piece, although the table gives us that. We only are considering when we're going to get our money back, and it's going to happen sometime between year 3 and 4, 3 years and something. So then this is the calculation of the partial year calculation for how much of the year. This is for a book problem where most people get kind of messed up to calculate the partial year. So this is kind of the tricky part. You get this down after a while, and then the partial year gets a little bit tricky for most people. So we're going to say one way to do that, we could say the amount that is still needed after this point. So we still need 50,000. We're looking at the point, which happens in year 3 and year 4, that we then clear the hurdle, that we get our money back. So we need this 50,000 is still what we need after year 3. And then we're going to compare that to the cash flow for the next year, which was 70,000. So 50,000 over the 70,000, that's going to be our percent of a year. So we're going to say, all right, that's going to give us the 50,000 over divided by 70,000. It's going to give us the 0.71% about. So the payback period then is going to be 3 years, 0.71 or 3.71 years. Also, be careful with this 0.71 because if it's a test question, they can represent that multiple different ways. They can give you how many days in a year. They can give you the amount of months in a year that they might represent it. They might not represent it at 0.71. So if you have 0.71 and they represent it in days, if they say 3 years and how many days, then you can say, all right, well, there's about 360. We'll make it even, 360. Closer to 365, but let's say 12 times 30, nice even months, gives us 360. If I multiply that times the 0.71, we're going to say, 3 years and 255 days about, right? Or if you want the months, if you want the number of months, if I calculated this number of days and divided by about 30 days in a month, we get to that 8.52 about. Or we could, of course, take the 12 months times 0.71, and we get about the 8.52. So 3 years and about 8.52 months, right? 8.5 months or something like that. So they might represent it in that format in an answer question. Make sure that you understand this second part of the calculation if it's a test question type of thing you're looking into. Just to emphasize that, you don't need to do this, but this is good practice to do in Excel, and you can see the same kind of running balance kind of situation if you break out, for example, this whole year from year 3 to year 4, as 360 days. So I'm just going to number it out 360 days. I won't go through each calculation, but it's easy to do in Excel, and it's a good practice to do it, and it might give you a better understanding of what's happening with this partial year calculation. So if I number this out 1 all the way down to 360, and then I do my calculation, and I'm going to say, all right, you know, the fraction of a year then is going to be, you know, 1 over 360, assuming 360 days is 0.002, so it's less than 0.00 at this time. And then I'm going to say that the payments that we need are going to be the 70,000 that we're going to accumulate over the fourth year. So 70,000 divided by 360 about days in a year is about 194. So if I run a running balance like this and I say, okay, for day 2 here, then now we're saying 2 days over 2 divided by 360 is about 1.01 or 1% of the year, right? And now we got another 149 in day 2 because we're assuming we're earning evenly over this time frame. So now we're going to take the 194 plus the 194, we get the 388 or 389 about. And if we continued this down, day 3 represents 3 days out of how many days in the year? We're going to say 360 about 12 times 30. And we get about that 0.01 again, close because it's rounded. Now we have the 194 because we're assuming we're earning that evenly over the years. So the 194 plus the 389 gives us the 583. And let's do it a couple more times. We got day 4 is 4 out of 360. So still about 0.01. And then we're going to take that 194 plus the 583. We get the 777. And then you can continue this on down till the 6th day. Let's pick up the 6th day. 6 over 360 gives us about 2.02, 2%. And then you can continue this down. And what I'm looking for is to see when we clear this 50,000. When do we clear this 50,000? If we did this running balance, easy to do in Excel, would be tedious to do this way. But if you look for when we clear the 50,000, it's way down here that we clear the 50,000. So that's going to be right here. So now we cleared the 50,000, same kind of process here. That's when we get paid back. So the fraction of a year then is the 257 or the 258. 257 over 360, about 71% or 0.71. And that's what we got up top again here. Just another way to kind of see this fraction of a year or do the same concept that we did when we did this running balance. Let's do the whole thing again with the second project. And now we've got product B here. Product B, project B, equipment B, whatever we're investing in. And so now we're going to do our same kind of analysis. We're going to say the initial investment is still the 220, but now we're looking at this series of payments for product B. So we're saying, when are we going to get our money back? When's the payback going to happen? So first we have the 220 minus the 90,000. That leaves us with 130 left. Then we have 130 we're going to get paid back in the second year. Year 2 is 55,000. So 130 minus 55,000 leaves us with 75. And then year 3, we're going to say year 3, we had the 60,000. So now we got the 50,000 because we're on the second one. So 75 minus 50 leaves us with 25. And then finally, once again, in the final year, we get paid back plus a profit of the 15,000. So the 25,000 minus the 40,000 leaves us with a profit of 15,000. That means we've got paid back. We have the 15,000 profit at that point in time. But our focus is, when do we get our money back? Happens sometime, once again, after the 3rd year, between the 3rd and 4th year. So then the question is, well, what's the fraction of the year? So we're going to say, all right, fraction of the year calculation looks something like this. We want the amount that we still need, which is the 25,000 after year 3. So 3 years and something, 25,000 over the amount that we expect to collect in year 4. We're assuming we collect it evenly over the year, 40,000. That's going to give us our fraction of the year, 0.63. So that's going to be the 25,000 over the 40,000, 0.625 about. So then, well, that would be exact. This would be about. So then if we want to see it, if they represent that in days, you could say 360 days, which would be 30 times 12. It could be 365, but we're using nice even numbers here, and that's going to be times the 0.63. That gives us our 225 days. If I divide that by 30 days in a month, then we get about 7.56 months. Or you could take, if they give you months, 12 months times the 0.63, 7.56 months about. And the payback period then is 3 years, 0.63. That's when the payback happens. When do we get payback? That's when we get paid back. That's when the money gets paid back. Okay, so then you could do the same calculation down here if you wanted to do it in Excel. I won't do the whole thing again, but just note, you could say, let's label it 1 through 360 days and see what fraction of a year that we get paid back in a similar fashion as we did when we looked at the yearly calculation. We could say, all right, well, one day out of 360 days is less than 1% of the year. And if we take the amount that we're going to earn over the year, which we're assuming it earned evenly, 40,000 divided by 360 days, that's about 111 that we're going to earn each day. So in day 2, we're going to have 111 plus 111. That's going to be 223 plus 111, and so on. When are we going to get to what we need to get? 25,000, clearing the 25,000. So when does this number clear 25,000? That's when we're paid back. That's when payback happens. So we're looking 25,000 down here. 25,000, there it is. So on day 225, so 225 day divided by 360 days in the year is about 0.625. 0.625. So scrolling back up, about 0.625, which is of course what we got here, 0.63 about. So 3 years, 0.63. Now, which one would we choose under the payback period? Well, this one's 3.63. We want the one that's lower because we want to get paid back sooner. So, and the one before, I can't remember what it was. It's way up here. I got to scroll way up here to find it, which is ridiculous. That's going to be 3.71. So notice the project B, we got paid back sooner. So under this scenario, we would be choosing project B because we got our money back sooner on the second project. And you can kind of see that due to the fact that this 90,000 is higher. But notice what it doesn't take into consideration. That just tells you when you got paid back. So this would be the common kind of scenario you would have for the conclusion here. Which one would you choose using just the payback period? We would choose the B. But which one is giving you more money at the end? Well, it looks like if I don't take into account time value of money, A is. And notice the payback period is not taking into consideration the total gross income here. It's only telling us when we get paid back. That's fine, but that's only one piece of information that we're going to want. It's one piece that we can then use for a future decision making. And book problems will often emphasize the points that the payback period does not cover, right? It only tells you when you get paid back. Now, it still might be that B is better because you get paid back more sooner because we're not taking into consideration the time value of money. So it might still be the case that B's, could come out better or worse. But that's going to be one of the kind of shortfalls of the payback period, is it doesn't take, and it will become more pronounced if you're talking and comparing projects that have different amounts of initial investments and they have different payback periods, meaning one gets paid back in 4 years, one gets paid back in 10 years. So again, good calculation to use, but it's only one of many. Book problems will typically emphasize the problems that someone would have. And that's what you would expect to see in a book problem. Like, here's the payback period. What is it missing? What are you not picking up? What could you be picking up if you use some other method, such as the net present value in conjunction with, along with net present value, internal rate of return, methods that take into consideration time value of money.